Futures under pressure after rallying Friday on that blowout jobs report. Treasury yields jumping on risk that economic growth and inflation will keep rates higher for longer. You're looking at the 10-year yield above that 4% level. Joining us now, we want to bring in Steve Sosnick. He's Interactive Brokers Chief Strategist. And Steve, it's great to kick off the week with you here on Set. Let's talk about what's going on in the market, because we saw the massive rally on the heels of that better than expected jobs print on Friday. Now here we are today, and it looks like investors are almost second guessing maybe that initial reaction. I'm curious, do you see maybe some signs that the setup right now might not be as attractive for stocks?
Well, first of all, good morning, Shauna. Good to kick off the week with both of you. Let's put this morning's sell-off in perspective. We're giving back basically the last half hour of Friday. So, you know, these are the kind of days where I get a lot of questions, why are we down? But no one asked me on Friday afternoon why we're ripping higher mysteriously in the last hour of the day. So, putting that all in perspective, yes, we do need to rethink the narrative that we've been coming in with. The economy is, you know, forget soft landing. Maybe we're having no landing. That's what this jobs report may be telling us. Also, you know, I think we'd all sort of thought mission accomplished on the stable prices part of the dual mandate. And on top of it, you had monthly hourly earnings rise more than expected, 4.4%. So this is tough. This is tough if you're sitting around waiting for massive rate cuts. The market pretty much told you by 2-year yields zooming about 25 basis points higher that's not coming. On the other hand, we should always be looking for a stronger economy, because that's really what drives stock prices.
And so with that in mind, I mean, essentially what you're telling us is when the markets rip higher, nobody's calling you to ask you questions, Steve. But I mean, at the end, you know, besides the jest there, it's really thinking about more largely here what this market is now kind of repricing as to where the Fed sits within whether they're behind the curve or not, which was the fear going into this most recent print.
Yeah, well, first of all, just to say the thing about people don't call, it's true. People don't call me. Markets are supposed to go up.
They're happy.
Yeah, exactly. Yeah. I call it socially acceptable volatility. If you get a move up, that's the same degree as the move down. People like the move up because it happens. It's what they want. When it moves down, that jolts reality, and that's when people call me. But in terms of resetting the narrative, this is exactly what we have to do now. I think we got all through this process. You know, I wrote something before Jackson Hole and went back through my notes of stuff I'd written before. And 2 years ago, they were hoping for a Fed pivot, which, by the way, they didn't pivot. They kept raising rates right through that whole thing. So the markets have always been ahead of the Fed. We're like children with candy. We always want that sugar rush. We're not necessarily going to get it. We don't necessarily deserve it. And that's okay, because why? Let me put it on the flip side. You know, we hear about monetary policy being too restrictive. Based upon what? We have stocks at all-time highs. We have bond yields basically at multi-year lows, even after this pullback recently. We have credit spreads very tight, meaning that corporations can borrow money if they need to. You have all kinds of risky assets doing well, you know, Bitcoin, et cetera. Where exactly is the restrictive monetary policy coming in? And so I think that, you know, Powell, I think the 50 basis point cut in hindsight was more of a let's catch up to the fact that I kind of wanted to do this in July and they wouldn't play along with me. So let's do the 50. But he was very clear for the markets not to expect more than 25. And the market said, we don't care. We're going to price in 50 anyway. And so here we are.
But then if we don't get, because we had Peter Chur on the program after we got the jobs report on Friday, and he was saying he actually wouldn't be surprised if the Fed does take a break if they do reduce by another 25 basis points at the meeting in November. Maybe they aren't going to move in December. And I guess just given what you were saying, just market expectations versus what the Fed has done, if we in fact do see the Fed take a much more measured approach and maybe what the market is pricing in, how is that problematic? Or I guess how should investors be looking at that?
It's not problematic in the sense of if the economy delivers, it's not problematic. Think about where we were at the start of the year. We were expecting a soft landing and 7 or 8 rate cuts. Where are my 7 or 8 rate cuts? We're not getting them. They're mathematically essentially impossible at this point. But the stock market didn't care because the economy was good. Earnings delivered. To me, the much bigger question becomes, What happens next? What happens at the end of this week when earnings season starts and into the next coming weeks? Can the earnings that's being priced in get delivered? Can we get double-digit earnings growth, which is priced into stocks right now, while having an economy weak enough to justify massive rate cuts? I don't see that happening. And so if I have to pick one, I'm always going to pick the stronger economy.
You know, I was looking at some of the FactSet data from late last week, saying essentially that the estimated S&P 500 Q3 growth rate for earnings is 4.2%. That's the expectation. What is the theme that you think propels this earnings season?
It's all about guidance, Brad. That's really what it's going to be. We've seen this multiple times when stocks. It used to always be that if stock beat its DPS estimate, then that was a good reason to rally. That is no longer a sufficient condition. It's a necessary condition. You're not going to rally if you don't beat your published EPS. But in an era where 75 to 80% of companies beat their EPS estimates, does it really matter so much as all the other stuff? People are looking through it. And again, you know, the 4.2% for Q3, but I'm talking, you know, double digit when we go out, you know, 4 quarters. Are companies going to basically be saying that the guidance that's priced into their stocks is adequate or sufficient or insufficient? And that, to me, is really going to be the key item to watch for, basically in almost every company that delivers earnings.
And Steve, as we step back and we head into earnings season, there's a list of things for investors to keep in mind at this point. But I think the argument, or one thing that investors continue to be a bit nervous about, are the lofty valuations and whether or not everything has to go exactly according to plan in order to keep some of this momentum alive. Are you at all nervous at all? I mean, maybe nervous isn't the best word to use here, but do the lofty expectations or lofty valuations, make you second guess maybe some of that trading action that we could see here, at least in the short term?
Absolutely. I mean, think about it. You know, the best analogy I could give here is sort of like high jumping or pole vaulting. As we keep raising the bar, which is fine as long as we keep clearing it. But if you raise the bar high enough, eventually you won't clear it. And that's why I focus on the guidance aspect of it, because it's really about, you know, is the economy going to be suitable for a wide range of companies to maximize their earnings in a way that investors are pricing in? When you have a 26 trailing PE, it's not a record high. We've been higher. We've been about 30, I think, in the late 90s. And actually in 2021, we were at 30 as well. But this is pretty lofty. And so you have to deliver. And again, if the companies can deliver, and a lot of that has been coming from the mega cap techs, both because of their weight in the index and their propensity to deliver solid earnings, you know, can the rest of the 493 continue to deliver? And can we see that from the stock market as a whole?
All right. Quite the accomplished stock market pole vaulter yourself. Steve Sosnick, Interactive Brokers. Thank you so much for taking the time.
My pleasure, Buzz. Thank you.
Ahead of the open.